What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So, Stag Industrial is a real estate investment trust that distributes monthly dividends. I'm going to do a dividend stock analysis review. I'll do a stock review, and I'll do a review on the company, and I'll provide my rationales as to why this is a good stock and a bad stock. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. Let's check this REIT out right now. So Stag Industrial is sitting at 2737. These guys are a real estate investment trust that is focused on the industrial sector, just like IIPR. So they have a 5.33% dividend yield, a PE ratio of 21.56, average volume 1.45 million, market cap 4.91 billion US dollars. Its year range is 2714 to 4827. So there is a major dip right now. Its day range is 2714 to 2792, and its previous close is 2806. So let's go over these guys as a company. These guys are a real estate investment trust that focuses on the acquisition and operation of industrial properties throughout the United States. By targeting this type of property, Stag has developed an investment strategy that helps investors find a powerful balance of income plus growth. So their enterprise value, 8.61 billion, square feet, 111.5 million. They're in 40 states, and they have 559 buildings, which is a lot. So I'll go over some of their acquisitions and their portfolio. They evaluate potential investments in all markets, with all credit profiles, with all lease terms. We avoid decision rules that limit the investable landscape and employ an analytical underwriting approach focused on an investment's ability to generate cash flow. They have 74 billions, 1.3 billion invested, and 12.9 square feet acquired. So here's their cumulative acquisition volume. With purchase price, so 2011 it was 129 up to 6,833. So I'll go over their acquisition platform overview. Their criteria is 100% occupied industrial buildings, vacant and partially vacant considered. Transaction type or investor sale, sale leaseback, build to suit, and spec forward commitments and funding considered. Use is warehouse distribution, light manufacturing. So people need warehouses, so that's huge. So the building type are class A or B in all construction types. All lease terms, location, all U.S. markets, focuses on primary and secondary industrial markets. The deal size I like is 5 to 100 million on a single tenant asset basis. No maximum for portfolios. Credit portfolio is all credit portfolios. So let's go over a few more things. I'm just going to use Ohio as an example. They have a lot of strategic locations. They have 34 buildings. So they're in Columbus, Cincinnati, and Dayton. In this area, Columbus is booming like crazy. So they have a lot of distribution warehouses and manufacturing. So Cleveland's a big area, so they target the big cities. And I'll go over another state as an example. Texas, an example. So they're in Dallas and Fort Worth. They have a lot of distribution warehouses in El Paso, Texas. Houston's a big city as well with manufacturing and distribution warehouses. People need these warehouses to distribute products. So that is huge. So the big thing about these guys is they're very specific in what they do. So I'm going to go over their revenue and their dividend history. So revenue-wise, these guys have exploded. This is in millions US dollars. 2015, it was 218. 2016, 250. 2017, 301. 2018, 350. 2019, 405. 2020, 483. And then 2021, 562. So there is a huge increase in revenue, which is very attractive with these guys. Now let's go over their dividend history. Let's check out their dividend history. Remember, they are a monthly dividend real estate investment trust. So 2014, they were 11 cents. 2015, they're still 11. 2015, they reached 12 cents. 2016 and 2017, they're still 12 cents. Still 12 cents at 2017, 2018. 2019, they're still 12 cents. 2020, they're still 12 cents. And then 2021, they are still 12 cents. And then 2022, they're still 12 cents. The payout ratio is 69%. The number of dividend increases in the last 5 years is 6. Annualized dividend growth in 5 years is 0.7%. So if you bought one share, you made 146 with a 5.33% dividend yield. So I'm going to tell you what I did with Stag. Let's go over this. So what I did is I sold my shares of Stag and I threw it into EPR Properties. EPR Properties has a 9.22% dividend yield, a PE ratio of 19.79, average volume 740.47K, market cap 2.69 billion US dollars. Year range is 34.58 to 56.38. Its day range is 35.50 to 36.60, and its previous close was 36.58. Now, these guys were hit so hard when the pandemic hit. Remember, these guys have properties. EPR Properties has properties that were really hit hard by the pandemic because they are entertainment properties, and I'll go over their portfolio. So with EPR Properties, their leading diversified experiential REIT, which is focused on continuing to grow their experiential portfolio of dry to locations. These properties offer an expanding variety of enduring, value-earning entertainment, recreation, and leisure activities. Separately, their education portfolio is a legacy investment that provides additional geographic and operator diversity. So they have 6.6 billion in investments, 358 locations, 200 plus tenants in 44 states and Canada. So they go over a lot of things. They are a major landlord to AMC, ski attractions, eat and play, experiential lodging, gaming, fitness and wellness, and cultural. So I'm going to go over a little bit more. So as a landlord, I'm just going to show you a few things. So with experimental lodging, they ski and eat and play. They're a major landlord to ski resorts. There's Boston Mills and Brandywine, Ohio. Top Golf. There's Mad River, Prep Academy. They do have some academies that they are, but they did get rid of some of them, according to recent news. So these Top Golf locations are huge. Here's a few other things with Nashville. They have Margaritaville Hotel. So also with lodging, these are the things. Now you notice why these guys got hit so hard, because look at their location, look what they own. And I'll go over their revenue and their dividend history shortly, but I just wanted to be very brief with these guys. So I'm going to go now to their revenue. So what happens? The pandemic hits, everything shuts down, their entertainment properties are hit hard. And this is what happened. Look at their revenue in millions US dollars. 421, 2016 493, 2017 518, 2018 693, 2019 651. Then the pandemic hit, 414. Then 2021 they're making a comeback at 531. So still a huge increase from 2015 to 2021, even with a pandemic. Now let's go over their dividend history. So check out the dividend growth of these guys. From 2013 they were 26 cents. 2014 they jumped to 29 cents. 2015, they jumped to 30 cents. 2016, they jumped to 32 cents. 2017, they jumped to 34 cents. 2018, they jumped to 36 cents. 2019, they jumped to 38 cents. Then the pandemic hit. They basically suspended their dividend. It makes sense, cutting cost and nobody's paying rent. So those buildings were just sitting there. And then they finally started to make a comeback in 2021. So their dividend is at 25 cents, which jumped up to 28 cents. So they're slowly making a comeback compared to Stag's dividend. Stag's dividend has terrible growth. This is why I sold them and threw them into EPR Properties. EPR Properties is well diversified, as is Stag. Now, don't get me wrong, Stag's a very good monthly dividend REIT, but the dividend growth is atrocious. The payout ratio is 75%. I'm not too concerned about that. Number of dividend increases in the last 5 years is 4. Annualized dividend growth in 5 years is minus 4.61%. Go figure, you have a pandemic. Annualized dividend, if you bought one share, you made $3.30 with a 9.22% dividend yield. So these guys are making a comeback. Their dividend is pretty strong. They did already hike their dividend post-pandemic as soon as they resume their dividend. So Stag, you're just sitting there. You're stagnant. I don't like the dividend growth, just like I don't like the dividend growth with Gladstone Land, which is why I sold it and put it into EPR properties. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. So I just wanted to go over the pros and cons of Stag. Stag is icy. Again, this is not financial advice for entertainment purposes only, disclaimer in the description. But Stag's dividend growth is atrocious. I don't like it. I'm not attracted to it. And that's why I jumped the gun, sold it, and put it into EPR properties since the market is taking a big hit. I will post a video tomorrow for you guys on Sunday, but I just wanted to make this address that Stag is no longer my monthly dividend REIT. You guys take care and have a good one.